For domestic asset purchases today, the competition is extremely high from foreign capital sources, both sovereign wealth funds, wealthy families, high net worth individuals around the globe, others that are motivated by tax structures. There's simply a lot of capital coming to the United States and really across all of the property types. I will say, though, that if you dig into the details for the capital that is attracted to the United States, the hospitality area is one that hasn't seen quite as much foreign investment. And the reasons for that, I think, are a few, but most importantly, it has to do with the cycle that we're within. If we all assume that the most comfortable investing is one that we're familiar with, if I live in a part of the world where the demand for hospitality type assets hasn't really come back, or the belief that business clientele or tourist clientele aren't really back as strong as they used to be prior to the recession, or even considerations of long-term trends, they're really not where they used to be in those parts of the world, then it stands to reason that that capital has been more hesitant to come into the United States, where they don't perceive it to be quite as strong as I believe it actually is. So today, all of the capital floating around looking for that safe harbor hasn't necessarily gone to hospitality, but today we believe there are real opportunities there. Single tenant net lease assets in particular, because of the pent-up demand for income, which there are so few other investment alternatives that provide income, is one that is comfortable, safe and secure, because odds are the source of that credit-driven income is a name that an end investor is quite comfortable with and is familiar with and probably has visited and is probably a shopper with even today. So it feels like a good place to go, particularly for individual investors that have appreciated properties that they need to sell and via 1031 exchange want to defer their taxes and can get into something that they're comfortable with, long-term income streams. However, because investors feel so comfortable with that, there's a tremendous demand for it. So any number of mergers and acquisitions have occurred within large portfolios of single-tenant net lease assets. The drive to seek out and grow those multi-billion-dollar portfolios and aggregations of those single-tenant net lease assets is very, very strong. I will say, from Behringer's standpoint, our approach to the single-tenant net lease marketplace is packaging together smaller portfolios, sort of in bite-sized chunks, where we're able to see those smaller portfolios with assets derived from relationships with developers, relationships with existing owners, those that have done business with us before, partners, in fact, that are comfortable with the way Behringer does business. It gives us a real competitive edge when we're not having to go through a bidding process that's subject to the landlords for the mega billion-dollar portfolios that are trying and have all the pressure to grow, paying up and bidding up those individual assets. So it's a marketplace that calls for a lot of caution, one that you need a skilled partner in order to execute on, or a skilled sponsor like Behringer. That's where we think we have a competitive edge, but the market trend is one to continue to watch and be certainly wary of as the cycle continues to move forward. Interest rates will be a significant factor for this, uniquely the single-tenant net lease marketplace. Today, in many cases, I'm familiar with the underwriting that a number of groups have gone through. The only way you can make a single-tenant net lease deal work today in some cases is because of the very attractive financing available today. As that financing perhaps becomes less available, then many single-tenant net lease assets may become tougher and tougher to justify. It's an interesting period.